Debt market update September 2023. G-Sec yields, which touched an intraday low of 7.07% during the month, ended the month at 7.22%, up 6 basis points relative to the month prior. The movement in yields was driven by multiple factors, including sharp surge in US Treasury yields, announcement of G-Sec being included in JP Morgan Global Bond Index, rise in crude oil prices, resilient credit growth, phase-wise reversal of incremental CRR by RBI, etc. Corporate bond spreads widened compared to last month. Average interbank liquidity fell sharply month-on-month, driven by significant outflow on account of advanced tax payments, phase-wise reversal of ICRR introduced by RBI in August, rise in currency in circulation, and OMO sales by RBI. FPI buying remained muted, and they net bought debt worth USD 0.12 billion in September 2023. Cumulatively, FPIs have bought debt worth USD 2.8 billion in H1 FY24, vis-a-vis being a net buyer of USD 0.6 billion during the same period last year. In the October meeting, MPC unanimously voted to keep the repo rate unchanged at 6.5% and also retained its policy stance of withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth, with a majority of 5-1. More importantly, the governor in their statement mentioned that RBI may have to consider open market operations of sale of government securities to actively manage liquidity. Outlook. While RBI maintaining the status quo on rates and stance was widely expected, announcement of conducting OMO sales to manage liquidity spooked the market. Given the timing and that the quantum of OMOs targeted are unknown, this announcement introduces a significant element of uncertainty for the bond market participants. Further, RBI remained hawkish in its communication with the governor, emphatically reiterating that the inflation target is 4% and not the range of 2 to 6%. Post the announcement, yields rose sharply across the curve, with yields at longer end rising more than the short end, and thus steepening the curve. While there was no change in policy rates or stance, RBI communication was relatively hawkish. By highlighting OMO sales explicitly as an active tool for liquidity management, RBI appears to convey its intention to remain actively disinflationary till the time it is confident of achieving its 4% inflation target on a durable basis. Going forward, we expect the debt market will likely be driven by both positive and negative factors. The key drivers which bode well for decline in yields include low risk of fiscal slippage, well-balanced demand-supply outlook of government securities, and significantly low net supply of SLR securities in H2 FY24. Further, robust growth in small saving collections is likely to result in no additional market borrowings, even in case of some fiscal slippage. Further, inclusion of India's sovereign securities in JP Morgan Bond Index from FY25 bode well for demand outlook for SLR securities and can effectively cap any significant rise in yields. CPI and core CPI are likely to trend lower in view of the correction in vegetable prices, decelerating momentum, lower input price pressure, and benign global commodity prices. Further inflation expectations remain well anchored and are trending lower. Growth rate is expected to trend lower in view of slowdown in services and goods exports, decline in fiscal impulse, and softness in private consumption. The bar for restart of rate hikes by RBI remains high, despite sharp rate hikes by US, as adequate foreign exchange reserves should keep pressure on INR at bay. However, RBI is expected to maintain an extended pause for a considerable period of time. However, there are counterbalancing factors which are likely to put upward pressure on yields. Uncertainty with regard to OMO's sales timing and quantum. Growth continues to remain robust, and if sustained, there is risk of core inflation reaccelerating. Headline CPI remains susceptible to elevated food price in view of temporal and spatial distribution of monsoon and its impact on crop yields. Credit demand remains robust and SLR holdings of banks remain high. Further, the demand from insurance sector might reduce too compared to last year. Thus, incremental demand from key buyers of G-Secs is likely to remain muted. Continued global monetary tightening and risk of rise in commodity prices, especially oil, driven by China reopening and geopolitical dynamics. Significant recent increase in global bond yields and rising upside risk to UST yields. On an overall basis, in our view, yields are likely to trade in a range. While we continue to recommend investments into short to medium duration debt funds, given the sharp rise in yields in the past couple of months, investors could consider higher allocation to longer duration funds in a staggered manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.